Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Chuck Fuller, Portfolio Manager in Nasdaq Dorsey Wright. We have Sara, Mehle, Senior Index Research Strategist at Nasdaq Investment Intelligence, and Josh Joffe, Managing Director and Head of Investments at Revolve Wealth Partners. We're here to discuss asset class rankings and fundamentals that have potentially been obscured by market narratives. It is great to have everyone with us. Welcome to Trade Talks. And Josh, I agree with you here. It feels at some point with this bout of volatility that we've seen, not much has really changed in terms of fundamentals, but that little bit of a hiccup almost felt like a pressure relief in a way as people were thinking about overextended valuations. It almost felt like a natural type of correction, or at least one that was needed.
Yeah, Jill, and thanks for having me. And that's exactly right. And that's the message that we've been preaching to our clients. The fundamentals to us, that story hasn't changed. We're still seeing slow growth. We're still seeing, record earnings. And the fact of the matter is, it was, almost a perfect storm within a market that was arguably extended. We had a little bit of softer jobs data come in. And you combine that with uncertainty around the elections, you combine that with tensions in the Middle East, a global unwind of the Japanese yen carry trade, and sure enough, we get the markets in turmoil headlines. But from our vantage point, the fundamentals haven't changed all that much.
Yeah, I thought the reaction was a bit overstated here. I mean, we even saw it in the VIX, the spot relative to the futures. The former was at 65, and the futures were somewhere around 36, 37. So while it was being compared to one of the top 3 vol events following the financial crisis and COVID, at the end of the day, it seemed more constructive, certainly, than those events. I mean, you had some folks out there calling for an intra-meeting rate cut. Now, in my mind, if we would have gotten that would have been the surprise event that I think, would have signaled that there's something amiss within the economy from a broader perspective.
Yeah, I think that's exactly right. And to us, the spike in vol and what we saw going on with the VIX is not really abnormal. I think what was really abnormal is the fact that volatility was as muted as it was for as long as it was. This was the longest stretch we had, I believe, going back to the GFC without a 2% decline in markets, and that just doesn't happen. VIX was at a 7-year low, if I'm not mistaken. So again, this is normal. This type of volatility, that's sort of what's to be expected if you're an equity investor. We talk about the average intra-year drawdown being 14.7%, or excuse me, 14.3% going back to 1950. So the idea of an 8, 9, 10% pullback, not unusual, not uncommon, and something you should expect, roughly 2 out of every 3 years.
No, that's why they call it averages, and we'll get into reasons why we want to be constructive on the market. But Chuck, let's talk about asset class rankings for a moment. I mean, equities still are, in fact, #1, and everyone was calling for a pullback. We got it.
Yeah. I think we talked about it the last couple trade talks that things were getting a little extended. There at the top in July, we'd had kind of 3 months where I think the markets were up over 10%, which that's the type of thing that if you see off a bottom, it makes sense, but without coming off of a bottom, it kind of makes you think that we're in at least a little bit of a bubble. And so we were kind of looking for a pullback. We got it. And like Josh said, it was a constructive pullback. We came back about 9 to 10%. We see that kind of thing happen, typically once a year. So we hadn't seen it yet this year. Really, the last time was back in October. Now, since then, we bounced back by 5, maybe 6% now. I think we're at a point where the market is roughly around this 50-day moving average. This is the part where if it is just a bounce, it should start to stall out here. If it keeps going on from here, then I think we're probably going to go back to new highs, and and who knows from there.
Yeah, and Sara, you have to be the content lucky charm, because every time you're on the show, the Nasdaq point and figure charts always has something interesting to say. What are your thoughts in terms of the longer term trend?
Yeah, I swear something always happens. There's something good between us, but there's always something to talk about. I have the chart pulled up right now, and that move on the chart actually did flip negative on Monday, August 5th. We actually fell down to levels last seen in May, down to 17,500. Since that time, we've actually rallied back up. We gave a buy signal at 18,500. And today, the move that makes me, I think, the most excited is that we're back up to 19,400, putting us one box now from moving back into an overall positive trend. So usually these trend lines are more of like brick walls, and they're hard to break through, and they're, on the upside and the downside. So I think that this kind of 1 week or 10-day shift is pretty notable. And I just looked at the Nasdaq 100 performance since Monday, August 5th. And taking into consideration today's action, we're up about 9%. So pretty notable move here. But I think that, once we see that trend flip back to positive, I think I'll feel a little bit better here. But we do have support down at 18,000. And then again, that low level that we hit in August being 17,500.
Right, and to Josh's point, staying invested in these markets, because sometimes these volatility pops and drops are great opportunities to pick up where perhaps you didn't get an opportunity from the prior run up. But Chuck, when we think about sectors, what's happening with technology? Has it moved based on the action that we've seen in the market over the past couple of weeks?
Yeah, so in our rankings, technology has been number one for a long time, really since like May of 2023. We saw it drop a bit with the sell-off. Obviously, the sell-off, affected technology stocks, more than others. Even through last night, through the last 30 days, technology is still down about 8%, where most sectors are positive again for the month. Now, so that brought it to number three, but I will say that the number 1, 2, and 3 ranks in our sector rankings are it's basically a dead heat. You've got financials officially at number 1 now, industrials at number 2. But any given day that can change, especially with the way technology is moving the past couple of days, and certainly today, we could see technology come back very soon.
Right, and Sara, what about from an index perspective? Does that mirror what Chuck has ascertained in terms of sector movement?
Yeah, so just looking back, so Chuck's looking at things from a relative strength perspective and trend perspective. I'm looking at things here from really strictly a performance perspective, so a little bit different. But just so far, month to date, so through since July 31st, we've seen strength in healthcare, utilities, cybersecurity, emerging markets over developed, and so far the top performing index so far this month through yesterday's close is the Nasdaq Lux Health Tech Index, up over 2%. So that's an interesting kind of twist there with healthcare, with a mix of technology there. But again, some of those areas of tech are popping more than others, like I mentioned, cybersecurity. But also, I thought it was a pretty notable to see that strength in healthcare and utilities.
Yeah, and Josh, let's go back to some of the reasons to be constructive here. If you think about it, the market has hit all-time highs based on fundamentals. Corporate earnings were quite good, which suggests that management teams have relatively been able to navigate a higher interest rate environment. I think that's a pretty decent sign relative to just being reliant on what the Fed does. I mean, if we were to get those 6-7 rate cuts that were expected in December 2023, in my mind, that would signal for that amount of moves in just 1 year that there are broader issues, right? So I think, fundamentally things have been pretty decent.
Yeah, we're very much aligned on that. And, even what Sara and Chuck were alluding to, the fact that it's not just 7 stocks and we're seeing more participation from financials, industrials, regional banks, signs of market breadth. That's a good thing, right? If we want to see this rally extend, we want to see this bull market continue. Earnings ultimately are what drives stock prices, and we now have more than 90% of S&P 500 companies reporting, and the earnings have risen 10.9% in the second quarter, right? Roughly 80% of companies have beaten consensus on EPS, 60% on sales. So these are good numbers. The recession talk, frankly, if you listen to a lot of these earnings calls, it's been mentioned less and less. The narrative keeps on intensifying, but that's not really what the market is signaling. It's not what corporate executives have been signaling. And in addition to what we're seeing from corporate earnings and profits, the consumer continues to spend, despite what we see from consumer sentiment figures, and that's 2/3 of GDP. I think we just printed 2.8, and the last estimate I saw was for 2.9. So, solid GDP growth quarter over quarter. A lot to feel constructive about. Household net worth is, pretty much at all-time highs. the labor market, maybe softening a touch, maybe seasonal, maybe not, but we're still looking at unemployment around 4% or 4.3. We created 114,000 new jobs last month. So I think there are a lot of positives that seem to be overshadowed here.
Yeah, and I would agree with you. I mean, if we were to get rate cuts and valuations are predicated on what the Fed is doing, I would find that really hard to justify multiples at where some of these stocks are trading at. And also when it comes to the Mag 7, the AI trade, and the broadening out of the market, if AI is here to stay and it needs to be incorporated in strategy across multiple sectors, there are other stories out there before the Mag 7. I mean, just think about an industrial company like Nasdaq 100, Honeywell, right? You think of it as an industrial company, you don't think that they're employing the latest in emerging technologies to bring all of their business lines forefront? I mean, it's impacting every industry.
Yeah, absolutely. And that's what we say. It's not just NVIDIA. I mean, if we believe, or if one is of the opinion that, this is going to be the next great innovation, the next great invention that's going to propel the next expansionary cycle, then it's going to extend beyond semiconductors alone. And I don't even think we've begun to see what some of those use cases are. And I think you're spot on. That impact is going to be felt across multiple industries, multiple sectors that haven't yet participated in this rally. And talking about the Fed, I think it's now, about 100% certainty, and we don't like to use those terms, but it seems like now, finally, September cuts are on the table. How much and how many is to be determined. But when you get the Fed cutting rates into a market that is exhibiting strength, that's a good thing, right? Historically, we tend to associate rate cuts with, emergency conditions, but that's not what's going on here. There are, there have been instances where we've cut rates into strong markets and it's propelled them further. And we think this may be another one of those instances here.
All right. And Chuck, to wrap up here, any other areas within the asset classes that of note that you want to make us aware of?
Yeah, international equities, they're still at number 2, kind of tied with commodities. International pulled back along with the U.S. though. Actually, earlier in April, they had kind of pulled back about, a little bit less than the U.S. had. So I was hopeful that would be the case this time, but it wasn't. They pulled back about as much. And there's been, a lot of weakness there. Really the best area so far this year within the international space has been Europe, up about 5%. Latin America has been the weakest at -10. But one interesting area within Latin America is Argentina. We know about some of the things that have been going on there with the new president, but I think what doesn't get talked about a lot is that Argentina's kind of bucked that trend in Latin America and are actually up 20% for the year.
Yeah, and Sara, to wrap it up with you, anything that you're seeing in the Nasdaq Global Indexes that stand out?
Yes, just U.S. focused. What I noticed is that obviously large caps continue to lead this month, although they are through yesterday's close were down. We'll see if that changes with today's action or the next few days. Mid caps right behind, but small caps really are that relative lagger, down almost 7% this month. So I thought that was a pretty surprising number to see. Some dispersion there between those two, but again, large caps continue march ahead.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.